Your stock portfolio is likely up a lot over the past year. If your portfolio closely mirrors the S&P 500 index, it's probably up north of 23% for the year. Does that mean that stocks are expensive? And what should we do about that? Over long periods of time, stocks have been the best hedge against rising inflation, which is why staying invested over long periods of time is so important. However, caution is warranted given current price levels. The price-to-earnings ratio, or the PE ratio, is the relationship between the price of a stock and its earnings. A simple way to think about this is that it's the price that you pay now to have access to the company's future earnings. Historical PE ratios have been around 15. That means that the stock price is 15 times next year's earnings for a company. So if a company is expected to make $10 next year per share, the price of the stock should be $150 if you want to own that $10 per share for forever. Right now, stocks are trading about 21 times those future earnings, meaning that same company costs $210 to buy instead of $150. So stocks are more expensive. Now, how does that sit with historical price levels? Price earnings ratios are approaching levels not seen since the tech bubble in the late 1990s. However, asset prices can remain inflated for long periods of time, and S&P 500 earnings are expected to grow. The S&P 500 is expected to produce earnings around $220 a share next year, which is a record high. Unlike 1999, those company earnings are real this time around. We've talked about the expense reductions that came from the pandemic and other videos. Those are likely here to stay. Earnings can continue to grow, and if you couple slower earnings growth with slower price growth, that price earnings ratio can catch up without a major market correction. As long-term investors, we remain fully invested in stocks because trying to time when valuations are going to go down and when a market correction is going to happen is extraordinarily difficult. However, in large cap US equity, we're positioning to avoid higher multiple growth stocks that are the most sensitive to interest rate increases and potential contractions if stocks do revalue. We also tend to favor small and mid caps as they benefit the most from post-pandemic reopening. Stocks in Europe, Asia, and other parts of the world have lagged the US benchmarks in 2021. Valuations in Western Europe and Japan, developed markets, are attractive relative to the United States. If you notice in the chart, you'll see the US is trading at 21.5 times future earnings, developed markets at 15.4, so that's Europe, Asia, Japan, and then emerging markets trading at 12.7 times future earnings. We expect high levels of GDP growth in some of these markets coming out of the pandemic, so their stocks are good values relative to the US. However, in international markets, company selection is key, and there are international markets that are worth the price of active management in our view. Finding the right international growth exposure without US dollar risk is key, as the dollar may strengthen as rates rise in the United States in 2022, and it's really important to mitigate that risk in your stock portfolio. So the key takeaway here is valuations are high, but we don't try to time the market because we're long-term investors, and so staying invested is key to generating compound growth in your portfolio.